Christmas and the New Year may be done and dusted, we're already past 12th night, and some of you may be embarking upon a dry January or even veganuary. But the festive season will still have a hold on investors' thought processes in the coming week, thanks to a fresh raft of trading updates from leading retailers. We've already had commentary from Next, Marks & Spencer, Tesco and Sainsbury to name but four to help set the tone, and next up will be Ocado on Tuesday the 14th of January, Currys on the 15th and Dunelm on the 16th. Now the trio target quite different end markets, so between them they could help investors to build a rounded picture of how confident, or otherwise, consumers are right now, although we must be aware that these numbers are backward-looking, while stock markets are forward-looking discounting mechanisms that are already trying to anticipate trends and events 1-2 years down the road and beyond. Now, Ocado is the 50-50 joint venture partner in a food delivery business with Marks & Spencer, and the trading statement will provide further colour here. Ocado's real focus is actually the Ocado Smart platform and the drive to license this out to major retailers and thus really be a software-driven intellectual property company rather than an online grocer. Even that ambition's had a couple of setbacks of late, as US grocer Kroger has paused its Ocado-powered warehouse rollout, and Canada's Sobeys has done the same, while at the same time Sobeys has relinquished its rights to an exclusive technology partnership. Here in the UK, long-time partner Morrisons is focused on using one rather than two so-called customer fulfillment centres, or CFCs. Now, all of this may help to explain why Ocado shares stand near 6-year lows, but this Christmas statement will focus just on the retail 50-50 venture. At the third quarter stage, according to September's trading update, active customers rose 10% year on year to just under 1.1 million. Average orders per week rose by 15% to 437,000, and the average basket size, well, that was broadly flat at £121. Average prices actually fell a little as Ocado invested in its competitive position here. As a result, third quarter sales rose 15.5% year on year, and the growth rate accelerated from prior quarters. For the full year, for the whole company, including licensing, management's now guiding towards low double-digit percentage growth. That's up from mid to high single-digit percentage growth previously, thanks to that strong third quarter performance. And it's also guiding to a 2.5% profit margin using earnings before interest, taxes, depreciation and amortization, or EBITDA, as a metric. However, that means the company remains as a whole loss-making, and analysts do not foresee profits until at least 2027 using statutory measures. Much, therefore, still depends upon the technology licensing arm. Currys shares trade at their highest marks in spring 2022, thanks to a key disposal, debt reduction, better than expected trading, and a bid interest from activist investor Elliott. Now, that approach came to nothing in the end, but Currys shares still trade well above the 67 pence a share offer that was tabled by Elliott nearly a year ago. The first headline figures to note are going to be the like-for-like sales trends in the UK and the Nordics. In the first 6 months of fiscal 2025, like-for-like revenues were up 5% year-on-year in the UK and Ireland, while the Nordic region suffered a 2% drop to give a group total of a 2% gain. Analysts will look for any changes in these trends in the third quarter and then see if Chief Executive Alex Baldock can provide any more detailed guidance for the full year to April now that peak season's in the books. So far, Mr. Baldock's guided to growth in profits and in cash flow, and the current analyst consensus forecast figures are as follows. Group sales of £8.6 billion, that's up 1% on a stated basis against 2024. Adjusted pre-tax profit of £140 million, up from £118 million, and free cash flow of £108 million, up from £82 million. Shares in homewares retailer Dunelm, which is a multi-channel offering through the stores and online proposition, well, they're broadly flat over the past year and actually over the past 5, perhaps owing to concerns over how higher interest rates could dampen the housing market and consumer sentiment, as well as the impact upon profits of higher wages and national insurance contributions. Earnings forecasts ebbed a little across the financial years to June 2023 and 2024, but the fiscal first quarter of 2025 showed more encouraging sales growth of 3.5% year on year. The base for comparison gets a bit easier from here onwards as well, and analysts looking for a 4% increase in the top line on a like-for-like basis in the second quarter in these numbers. After that, attention will switch to any guidance for the whole year from Chief Executive Nick Wilkinson, especially thanks to those cost increases, even if the bulk of those may fall into the year to June 2026. So far, Mr. Wilkinson has simply stated that gross margin will come in between 51 and 52%, against 51.8% last year. And when analysts plug that into their forecast of 5% stated sales growth to 1.8 billion, well, we get a pre-tax profit forecast of £213 million, up 4% year on year for the 12 months to June 2025. I hope that you and your families are all keeping well. May 2025 bring you good health and happiness. Thank you for watching, and I look forward to seeing you again next time.